Bonjour à toutes et à tous. Merci de nous rejoindre en cette période qui sont déjà les départs en vacances. Et merci à Amelia de venir nous présenter ce rapport de la CNUCED et les travaux de la CNUCED sur l'investissement dans les énergies propres dans les pays en développement. So I will switch to English. Amelia Santos Paulino is the Chief of Investment Research at UNCTAD'S, CNUCED for the French-speaking crowd. She holds a PhD from the University of Kent and also participated in an executive education program at Harvard Kennedy School of Government. And prior to working for UNCTAD, Amelia was a research fellow at the UN World Institute for Development Economics Research in Helsinki, and at the University of California, Davis. She comes from the Dominican Republic, where she studied and also worked for the central bank as a professor of economics, and later in a temporary position, as if I understand, as a trade negotiator. Amelia will share with us the main findings of the just published World Investment Report 2023. For those of you who are not familiar with the UNCTAD annual report, it is renowned for assessing the latest trends in foreign direct investment around the world, and particularly in developing countries. Together with UNCTAD database, it is a very precious source of information on cross-border investments, both in geographical and sectoral terms. The 2023 edition of the report also focuses on the growing and abysmal investment gap facing developing countries in the fight against climate change. It points out that whereas international investment in renewable energy has nearly tripled since the adoption of the Paris Agreement in 2015, much of this growth has been concentrated in developed countries. So Amelia will share with us the UNCTAD detailed assessment of the situation and the organization's view on what is to be done. So I will list just a few issues very quickly, which come to my mind, but there are many others. Among these issues are the identification of the actual investment needs and the adequate planning in countries that sometimes have rather limited technical capacities, the determination of the adequate policy tools to incentivize these investment, taking into account that these countries have very little room for maneuver. The very difficult and key issue of the cost of capital, but also the modalities that such investment can have, in particular the pros and the cons of private-public partnerships, the role of domestic savings and domestic capital market, domestic capital markets, and when it comes to foreign financing, the issues of investment protection agreements, the contribution of plurilateral and multilateral banks, and how to tackle the many risks associated with the investment in the energy sector, that is technical uncertainties, counterparty risk, political risk, foreign exchange risk, and so on and so forth. So it is a difficult and long agenda for a short session, but I'm sure Amelia will tackle all these issues and many others, and the floor is yours.
Merci Christophe, merci à le club pour l'invitation. Je vais parler en anglais si vous me permettez. Thank you so much, and it's a great pleasure to presenting and discussing the findings of the report with academics, researchers, and also I'm happy to see colleagues from the OECD and from the policy world attending the conversation today. I am a fan of your institution. We use your research, your data, especially to understand bilateral and multilateral investment and trade relations between countries. So I look forward to continue the conversation with you beyond this presentation. So if you allow me, I'll share my screen. And I will speak, as Christophe said, on the main findings of the report, and because the report is so rich and it has so many angles, including the trends, the policy, and the core of the report. I will focus my presentation on the trends, especially zooming in on what has been the trends related to the energy transition, which is the topic of the report. And also, I will discuss the role of not only the real investment, the upstream of the investment, but also downstream in terms of trends in sustainable development. So first I will cover international investment trends, including capital markets, and then I will focus on the theme chapter of the report. As Christophe mentioned, we are at a very critical moment. We are 7 years, less than 7 years. We are at midpoint of the deadline of the 2030 development agenda. I would like to say to achieve the SDGs, because it's a very complex agenda, but to meet the targets that were set in 2015. And suddenly, in addition to the urgency of the sustainable development goals in general, we wake up to the news that countries are also making commitment in terms of the conferences of the part, starting in the Paris Declaration, and following the Paris Agreement, the energy transition has become a key driver of development planning in developing countries. I will come back to this in my presentation because it's important to understand the role that investment plays on this agenda, because countries need resources. Developing countries need resources, especially in the context of a growing gap to meet the SDGs. So, as I said, I will start with the trends and prospects. Here I show the different type of flows that describe what are international investment trends. And basically we can see in this chart that the flows varies according to the type of investment that we are discussing. But the main headline is that FDI flows, foreign direct investment flows, declined in 2022 by 12%, mostly due to the slowdown, to the decrease in financial activities. So as we can see here in the bottom left, cross-border mergers and acquisition, which are what explain financial transactions between multinational enterprises, declined by 4%. And this decline in the volumes of financial transactions in developed countries was due basically to the global macroeconomic and global political environment, but also to the slowdown in the support packages that these countries received. So this is the driver of this decline of 12% in 2022. So if we look at real investment trends, what we call greenfield projects announcement, and which is the what it shows the intention of investors to invest in particular sectors, and international project finance, which is what basically explain investment in large infrastructure sectors, including the energy and renewable energy. Here, the trend is more positive, especially greenfield projects announcement, which increased by 15%. So this growth was also highly skewed and concentrated. We show in the report that foreign direct investment in developing countries increased only marginally and concentrated in very few large emerging countries, as I will show in a minute. So inflows to smaller developing countries remain stagnant, especially to the least developed countries where inflows decline. So in general, we point in the report, if you read chapter 1 of the World Investment Report, we point that global FDI retreated, but that what we call new project announcements show a bright spot, as we can see, with a 15% increase of greenfield projects. This is good news for structural transformation prospects of developing countries, but the slowdown on international project finance is a matter of concern because, as I will show you later, this is a core vehicle for investment in renewables and investment in the energy transformation in developing countries. So I just mentioned basically this divide in this divergence, pardon me, in terms of regions and growth, and the decline, as I just noted, in developed economies reflected the uncertainty for the investors, uncertainty mostly in financial markets, and basically the winding up of the stimulus package that they received, especially in the COVID and post-COVID environment. Also, the volatile nature of these financial flows in developed markets have affected aggregate values of foreign direct investment. In Europe, in addition to the winding up, the slowdown of the stimulus package, in Europe, another determinant of the slowdown has been that fluctuations in the major conduit economies. And this is something that we have been working in different, since many years at the World Investment Report, trying to explain the real trends, taking out what is the contribution of conduit economies to global foreign direct investment. As we know, these are not real investment, these are transit flows. So basically, this is one of the issues that explain the negative values in Europe. In the US, mostly mergers and acquisitions halved, and then this explains also the slowdown of foreign direct investment of around 26% in the US. When we look at developing economies, it was marginal, but it was positive. And again, we see a big divide between regions. Africa, a significant decline after a record level that was seen in 2021. And this peak, and this is why it is important to understand the different type of flows, because this peak in 2021 was explained by a single, by very anomalous peak caused by just one large corporation restructuring. So this was what drove those that follow the trends in Africa, what drove the peak in 2021. Good news in Latin America and the Caribbean, it was an increase over 50%. And again, I invite you to read the full trends to see which were the countries, especially resource-based economies, countries that are driving the energy transition, but also smaller economies in the Caribbean, like the Dominican Republic, where the tourism sector remained resilient despite the COVID and the different shocks. So basically, we can see that in Asia, which is the manufacturing center of the world, flows remain stagnant. So we have here a very diverse picture, but I think a key message, important message here, is that the impact of this multidimensional crisis that we are living, especially the food and the energy crisis, and also the financial and the debt distress in many countries, had hit investment flows, especially in the poorest countries, where the shock has been disproportionate, as we can see in the minus 44% in Africa. So moving on to one of the key aspects of the report is since 2020, we have been analyzing by mandate of the General Assembly what is the trends in investment-related sustainable development goal sectors. I always make the point, and I'm becoming boring at this. I don't want to sound boring, but I just want to make the disclaimer that it's impossible due to data availability to track every single goal and every single target related to the SDGs. So what we did in 2014, it was a pioneer exercise, was to determine what are the investment-related sectors, which we group here in this table, including infrastructure, renewable energy, water, the provision of water and sanitation, agri-food systems, and health and education. And we tried in 2014 to estimate what was the gap. And also then from 2020 we are looking at the growth in or at the performance of investment, international investment in this sector. So here we have two messages. We saw that international investment activity in the SDG sectors increased and was a substantial increase in 2022, but the growth was unbalanced. And as we can see, the largest growth is seen in infrastructure and in some in infrastructure, including transport, power generation, and distribution, which, by the way, includes traditional energy. So this is a bit worrying. But then when we compare two, we also make the comparison with the trends just after the SDGs, that the SDGs were launched. So if we compare to 2015, when the 2030 Development Agenda started and the SDGs were adopted, the progress is modest. So this is a matter of concern, especially if you see what the shock to the agri-food system, which brings the development concerns to the forefront, especially in terms of food security, in terms of capacity, in terms of technical development in developing countries. Because we saw, I mean, if you compare that, we were supposed to be on an upward trend, and here is almost 20% decline compared to 2015. A good news, and again, if you read the report, is that still developing countries remain a key destination to food processing and manufacturing, which is a way of attracting more international investment into the sector. Just quickly to wrap up here, as I mentioned at the beginning, the report presents an update of the analysis that we did in 2014. So at the time, we estimated the gap, the investment gap to meet the SDGs was 2.5 trillion in 2015. Now, the review and the analysis presented in the report shows that the gap has enlarged to more than 4 trillion per year today. And this is due to two issues. One is underinvestment, and the other is to additional needs. So it's a big worrying sign. And also, we show that the largest gap are in the energy, water, and transport infrastructure. So this is a matter of concern if we are serious about the overlapping agendas of the Conference of the Parts, the COP, and the SDG agenda. And I invite you to read the report. Let me move on quickly because I want to get to the core of our analysis. And here this figure tries to zoom in into what is the topic of the report. We present a very rich and detailed analysis of what are investment needs and investment gap in the renewable energy sector to try to understand what is the real gap and what is the real need for the energy transition. This also includes some analysis of the different components of the transition, and also analysis of what is the value chain, where we show a big concentration in developed countries and also very few developing economies, including China. But back to this graph, as Christophe mentioned on his introduction, renewables energies investment activity in renewable energy nearly tripled since 2015. But as we show in the report, this growth slowed down in 2022, basically because the slowdown in international project finance. where the most significant deals on infrastructure are take place. So basically the slowdown is due to international project finance. Again, a key issue is that most of this growth, the growth that we explained, has been experienced in developed countries, particularly in Europe, due to the strong policy support that I just mentioned, and which provided a push for infrastructure and renewable energy projects. You know, you are all familiar with the new policies at the European Union level, the issues in the US, the Inflation Reduction Act, which I think is the wrong name, but all in all, the policy support is there for the transition. However, in developing regions, the growth of international project finance was more gradual. And although it has outpaced the growth of what is economic activity measured by GDP growth, but only marginally, as we can see here in the figure. In LDCs, where the need for investment, not only in traditional in the energy transition, but in energy access for all, is especially high. We see that investment in renewable, especially international investment, has lagged GDP growth. So basically, if we look at this figure since 2015, LDCs has seen the number of projects, renewable projects, increase by only 1%, while their economies grew 7 times faster. So the investment, the gap between the energy needed for productivity and for economic activity is large. So basically the message here is that we need a more widespread growth of investment in the energy transition. So this is like, I wanted to give you a global picture. I didn't have time to go into all the figures of and tables of the chapter. Also in the theme chapter, I invite you to read all the trends analysis, which is very, and we work very closely with the International Energy Agency and with IRENA, not only on the trends, but also on the policy part to understand, and the idea is to have a common voice in when it comes to analyze what drives the energy transition and what drives the investment in the energy transition. So we are grateful to colleagues from both agencies and colleagues based in Paris. So I will pass quickly by the capital markets and sustainable finance trend. And a key message of this part of the report is that sustainability themed investment remains resilient despite volatile capital markets. And I see this as a contradiction because I just mentioned that we have a 4 trillion investment gap. And then we see a expansion in capital markets and sustainable finance and sustainability theme instruments. So how do we get these fundings from the capital market down to developing countries and to the real economy is a matter of concern. And this is why UNCTAD has been advocated, not only for this analysis, but also to work with the stakeholders on this field. So just quickly here, as I said, sustainability themed investment remain resilient, and something that we show in the report that comparing sustainable funds and traditional funds, there were more issuance of sustainable funds, basically showing net inflows compared with traditional funds that show net outflows. So sustainable bond issuance continued to expand, and it has grown 5-fold over the past 5 years. And here, the key priorities for the market are to increase exposure to developing countries, but also to address greenwashing concern. From us, as a development-oriented institution, these are 2 important issues that need to be addressed. It's not only the expansion, but many of these funds remain in developed countries and they don't make it to developing countries. And also the issue of greenwashing and self-reporting is a matter of concern. I will not go into detail, but I think there is a big prospect for the development agenda to benefit from the expansion in capital markets. And as I said, sustainable funds continue to be more attractive to investors than traditional funds. Just quickly here, this message also, as I said, I mean, there was a slowdown on green bonds, but in general, what is social bonds, which are important for the sustainable development agenda, continue to expand. Another aspect that we look at the report, and also important for the development agenda, is the role that capital markets and institutional investors play in promoting responsible investment, including gender equality. We have been reporting indicators on equality at the board and by industries and by sectors. So if you're interested, I invite you to read the report. So basically, a message here is that capital market infrastructure, such as stock exchanges and derivatives exchanges, are a key leverage point in the investment chain, and they can exert a significant influence in market participants. Since the launch of the UN Global Compact, we have seen a push for the mandatory environmental social governance listing requirements, and also on training the market, and all related to reporting. So in this sense, and also as a sign of commitment to increase the contribution of the possible contribution of financial markets to the SDGs, we at UNCTAD launched at the World Investment Forum in 2021, the Global Sustainable Finance Observatory. So this is a way of working with the market, but also we have the initiative for institutional investors and the program for international standards and accounting reporting. So this is also, we want to not just to focus on one side of the investment equation, but as I said, in the upstream and downstream part of the story. So I'm conscious of time. So if you allow me, please, I will move to the core, to the theme chapter of the report. As those of you that are familiar with the World Investment Report, every year the topic of the report changes to address an important issue for the international community, but also to developing countries. So I already mentioned that renewable energy investment has tripled, but the investment needs for the energy transition are enormous, and much more is needed. So this is not a secret, and it's something that is voiced by other agencies, as I said, as the International Energy Agency and other colleagues from the Climate Change Convention of the UN. So as I also mentioned, this growth has been unbalanced since most of the investment is concentrated in developed countries. A key concern here, and I want to put it on the table, is that while investment in renewables has grown, other sectors relevant for the energy transition, especially energy infrastructure, still observes much lower investment by international investors. So we cannot be blinded by the aggregates. We have to see what happens at the bottom and at the middle of the distribution, and especially at the composition of this sustainable energy for all. And something that I didn't mention earlier and that is important is that when I did mention that the gaps are important in renewable energy and infrastructure, but this gap make almost half of the gaps to meet all the SDGs. So if the 4 trillion gap for the SDGs, out of this, around 2 trillion is the need for the energy transition and sustainable energy for all. So as I already noted, we did a very detailed analysis of needs, not only by sectors and subsectors, but also by type of countries. And it is unfortunate that we see this disparity when it comes to investment needs and the capacity and the attraction of foreign investment. And this is why it is very important to place international investment in the context of the total energy transition, confirming what is the role really here of that international investors can play. So here, for example, in the report, we show that international renewable energy sector, if we take international project finance, for example, it accounts for 55% of global values. If you zoom in into least developed countries, IPF, International Project Finance, represents over 75% of investment in renewable energy and infrastructure in least developed countries. So this is a very important instrument. But I mean, going back to this figure, basically a message here, what we see is that energy investment is not going to the countries that need it the most, renewable energy. So here we have the countries ranked by the access to electricity, and then we have the investment. So basically, countries that have low access to electricity receive 50 times less investment in renewable energy than those that have high access to electricity. So saying it in another way, developing countries where almost all of the population has access to electricity have received 50 times more international investment in renewable energy per capita compared to countries with the lowest access to electricity. Another important number that we show in the report that is a really a red flag is that we observe that today 31 developing countries, including LDCs, have not received a single utility-size investment project in renewable energy or any other energy transition sector. So 31 developing countries still have not registered a single utility-size project, which is a significant number, and which is also a warning if we are serious about meeting the Paris Agreement and the SDG targets. So as I said, we also look in details. We try to understand which are the countries where investment that are more attractive or that attract more diversified investment. So what we show in the report that those countries that manage to attract diversified investment also manage to bring foreign direct investment into the renewable sectors. So here in this figure, we show the top 10 countries, and also we can see that in many of the top 10 developing countries with the highest level of international investment in renewable energy, international investment in renewables represents between 1/10 to 1/3 of total FDI. So here there is a sort of correlation between share in renewable energies and the share of total investment to these countries. So before moving on into more results and analysis, I wanted to pause here and show you what was our framework, because in addition to understanding the needs and the trends, we wanted to explain what are the factors that drive investors' decision in new energy infrastructure. And this is a key contribution of the report. It's a novelty of the report. Not many have placed this discussion in the development agenda. Many of the reports are highly technical from the engineering and technical viewpoint or from the finance, but we here try to understand really what drives investors' decision in new energy infrastructure, and what is the cost of that investment in developing countries. And as you can see here, the investment decisions are driven by many factors, including economic, technological, regulatory, and environmental. And here we cannot underestimate the importance of the political context. It really matters, especially issues related to energy security concerns, to the planning process of these countries. We interview many investors, high-profile investors, and they say the first thing that they look at is the regulatory framework and how well prepared the plans of these countries are. So we also analyze the national determined contributions, as I will show in a minute, and the energy transition strategy. So all this we're taking into consideration into an analytical process, and also into the empirical analysis presented in the report. And one important issue is not only the availability of resources and what is the initial conditions of the country, but also the role that partnerships can play in overcoming some of these concerns and some of these constraints. And that also we analyze empirically with data in a very disaggregated, granular way in the report. So before going ahead, as I said, this is the basis of the analysis that we presented. And of course, as you saw in the previous figure, regulatory risk, lack of support from multilateral agencies, and risk of stranded assets associated with fossil fuel installations can explain the large difference in the cost of capital between projects in renewables and traditional energy, and also between countries, between different types of countries. And this difference is over 100 basis points. And you see also here the difference between developing countries and the UN definition of least developed countries. So high financing costs are a key obstacle to attracting investment in renewable energy. And we try to see how we can overcome this cost in developing countries. And as I said, this is what we use as a core for our analysis of the cost of energy, and in addition to other indicators that I will mention briefly, and also the role of policy in this process. I will move quickly because I'm running out of time and I want to leave time for the discussion. So here, one issue is not, I mean, of course, the cost of capital matters, but investment decisions for new power plants are related to the choice of different technologies and between different sources of energies. And also, these decisions are made based on the comparison of the cost of the electricity generated over the lifetime of the project, and also different types of installation on an equal footing. So here we try to compare what is the localized cost of energy and the discount rate, which is a key measure. These two, I mean, the LCOE, the localized cost of energy, is a key measure to have a basis for comparison of the rate of returns and how attractive or costly is for an investor to go into a different type of energy or into new energy infrastructure in developing countries. This cost of energy, this localized cost of energy, is driven by numerous factors that related to the figure that I just presented earlier, including technical, capacity, operating cost, the price of fuel and maintenance, and also the commissioning costs. How expensive it is to offload dirty assets. And these are, I mean, some of these costs are the same for domestic and international investors, but there are other risks that affect international investors more. So here we see that when the discount rate increases, renewables lose competitiveness 3 times faster than non-renewable. And this is important because the high cost, the upfront costs of renewable energies are very high when compared to other sources of energy and can be a deterrent for investment. This upfront capital cost can be very high, can be a disincentive for investment. And so this is an issue that we take into consideration on the analysis. So for example, to give you an example, the IEA, they show in the report that the cost of capital can determine 50% of the localized cost of energy, let's say in the case of solar installations in developing countries. So it has an important impact on how attractive it is for investors to come into these sectors. And for example, we also show in the report, based on our own data and also the analysis of other data, that the cost of capital for energy projects in 2022 was almost 3 times higher in developing countries than in developed countries. And this is again a matter of concern for policymakers when designing their strategies for the transition. So zooming in, I mean, we have a wealth of analysis by type of instruments, by type of countries, but a key message, as I said at the beginning of the report, is the role of partnerships. So what we did an analysis to see basically how the borrowing costs for investors in sustainable energy projects can vary depending on the role of different actors. And I already explained what drives the investment decisions, that is related to country, industry, and project risk factors. This is one issue, but then how we address this? What is the role of different actors? We compare this to the role of traditional policy instruments, and compared to partnerships, traditional policy instruments like subsidies have a lower impact. The role is not as important, and they are more expensive. They are costlier. So here we cannot underestimate the importance of partnerships. So this figure, what shows is that, for example, bringing an international investor into a project can lower the spread on debt financing by 8%. So it's a significant, already is an important impact. If you bring in a multilateral development bank, reduces by other 10%. And then when we go to what could be seen as a public-private partnership, including non-traditional multilateral actors like the Belt and Road Initiative, this can reduce the cost of capital almost by 40%. So, I mean, this is a long-standing debate in finance and development literature, the importance of partnership, but this is a novel analysis that tells you that if designed well and implemented well, PPPs can reduce cost of capital and the debt spread by 40% in developing countries. Moving quickly, as I said, planning national energy transition plans are crucial for investors' confidence. We did a thorough analysis. Some of my co-authors and research assistants are in the room today, in the virtual space, listening to this, and I'm very proud for the work we did. We look at all the national determined contributions, and we saw that over 147 countries following the Paris Agreement presented a national determined contribution. But when you go into detail, we see that they have ambitious targets. Many of them, some developing countries that are low-income countries, have a target of net zero by 2035, which I think is unrealistic. Then we go down, and then we wanted to understand, okay, how do they plan to finance this? Only 48 countries had specified investment requirements. And out of these, only 40 had specified sources of finance. And the most common ones, the top three, were MDBs and international financial institutions, government and domestic public incentives, and private investors. Unfortunately, I don't have time to go into the discussion of incentives, but one of the messages when we did in the policy chapter of the report, we did a very comprehensive analysis, and we still see that subsidies to fossil fuels are still 8 times higher than to renewable energies. And then you have many countries that go all the way to implement very sophisticated investment energy investment related policy tools that have nothing to do with their planning. So we saw more than 800 policy measures that were not part of a consistent and coherent energy transition plan, which is also a matter of concern. But,
Amelia,
yes.
Can you wrap up?
Okay, perfect.
So that we have some time for the discussion. Thank you very much.
No, my pleasure. So I will wrap up now. So basically, we discussed at the end of the theme chapter, we discussed the challenges for international investment in the energy transition. And based on the analysis of foreign direct investment, project finance, investment policy, and sustainable finance trends. And then we classified the challenges according to these 4 groups, and then we provide solutions, especially in terms of partnerships, in terms of policies, and in terms of multilateral collaboration. I invite you to read. I don't have time to go into details. And just how do we respond to these challenges? Yes, it's good to identify them, but we need solutions. So we present a very detailed, what we call Global Action Compact for Investment in Sustainable for All. And basically the design of this compact was accompanied by guiding principles. And we provide recommendations basically for design criteria for investment strategies, policies, and treaties. And there we look into the role of international investment treaties and as an incentive or possible disincentive for the transition, in addition to national policies and so on. I will stop here, and thank you so much for listening to me, and I look forward to the comments and discussion.
Thank you very much, Amelia. I will give the floor to Vincent without further ado.
Thank you, Christophe, and I would like to thank Amelia for the presentation. I'm really glad that she accepted to present the World Investment Report, because this is always a really rich report, and I really mean it. Over the years, I've developed rich insight on the role of multinational and SDGs investment. So I think this is really a really great contribution, and really different. The focus is really different from the report from other international organizations. So this is also something really useful. So I don't want to take too much time, and there are lots of material in the report. So the focus is really this year on the role of international investment policies and international investment in general in energy transition and the investment in renewable energy in particular. So there is no question that this is a fundamental issue, a fundamental long-term issue. But clearly the role of FDI is less obvious, and the report really provides rich insight on the measurement of the role of FDI, identifying the relevant dimension with respect to FDI in this area, and which is not clear. And so I think that the report provides an interesting framework to think about this and to think about the determinants of energy investment, and also some guidance and policy recommendations that are useful. So as I said, I don't want to take too much time, so I will focus on two parts. So the first part is not the real focus of the report, so the investment trends that Amelia presented at the beginning, because I think this is something which is every year in the report, but which is particularly important this year. And then I will go to the last part of the report on sustainable energy for all. So I would like to begin by saying a word on the question, the trends on FDI that we can assess from the report, because I think this is a particularly important and interesting this year, because there are lots of questions after 2022 over the future of globalization. So everyone has heard about reshoring, nearshoring, decoupling, de-risking, etc., etc. So lots of new words that are used more and more in the policy arena, international policy arena. Nothing is really happening in the trade flows, and so this is why I think this focus of the report on FDI is important, particularly this year, because this can be used as an early indicator of future globalization trends. So I won't say there are lots of information on that in the report, so I will just focus on some of them. So as Amelia said, there has been a decline in FDI by 12% in 2022 after a rebound in 2021, but this is driven mainly by merger and acquisition. And so we know that this merger and acquisition happen through waves, and they have specific determinants. And so what's more interesting in terms of what's happening for the future of globalization is mostly greenfield project, and these greenfield projects have increased both in number and values, and this is what's most related to the future of trade. And what we can see also is that the profit level and the profitability of multinational enterprises are high, and really high in terms of historical trends. So the profitability of this international investment have not decreased, even though the international environment has become more confrontational, clearly. So there are just three questions on which we have some insight from the report. The first one is what is the impact of the Inflation Reduction Act, and in particular on the competition for FDI? And then what you can see is that in the aggregate, the investment in the US are quite stable, but this is interesting to see that there are really specific sectors and green sectors, which are the focus of the IRA, which are quite dynamic in the US, battery production in particular, solar energy components, etc., etc. So this is something interesting in this respect. But what you can see also is that in this particular sector, the EU is also experiencing an increase in the number of projects. So there is no competition, at least these are sectors which are investing a lot, and international investment are going in the US, but also in the EU. So there is no clear trends of competition between the two, at least. The second issue is the relocation of activity away from China, which is a topic which has been raised quite a lot given the confrontation between the US and China, or more broadly, the idea of different blocs in the international arena. And what we can see is that the flows to China rose, and there are mostly flows from Europe and multinational, which is interesting in itself. And we have also an increase in investment in the rest of Asia, and in particular Southeast Asia, with a record investment, which is also interesting in terms of alternative location for production to China. And finally, just one quick comment on the other specific trends in GVC-intensive industries, and in particular, greenfield investment have increased both in number and values in these GVC-intensive industries, and particularly the electric vehicle, sector. But this is true in the EU, in the US, and in Mexico. And also for the semiconductor industry, for the battery industry, you've got investment which are spread all over the world. So I think this is all of these give interesting insight, at least in this respect. I won't say more, but I think there are a lot to be taken from this part of the report. So just going to the main part of the report, and so I won't repeat what Amelia presented, because this is really clear that they document the specific role of FDI in the renewable energy investment, particularly for least developed countries, because of this issue of the cost of capital and the specific importance of the cost of capital for renewable investment compared to fossil fuel investment. And so clearly this is important. And the second one is the concentration of the energy sector FDI in countries where they are the least needed. And so then the report documents clearly that there are some policy instruments. There are some instruments that we can use both at the international level, for instance, reforming the international investment agreements, the role of the multilateral development banks, and at the national level with these strategies, detailing the investment planning in national energy transition strategies, which are really important. But in the end, one question we may ask is that since FDI determinants are multidimensional, so economic factor, technological factor, regulatory factors, so you really highlight this different dimension. But what you highlight also is that FDI in the energy sector is not going to countries where there is no FDI at all. And so the question, maybe to be a bit provocative, is can FDI play a role at all in these countries, given the structural issues and structural weakness in terms of FDI attractiveness? Okay, so this is maybe a general question, but I think this is a question that is interesting to ask. Just a quick second question on this part. So you emphasize in the report that the current economic challenges which are related to the increase in the interest rate and the slow growth, which is clear. I was wondering, there are at least one or two interrelated issues related to the changing global environment last year. And I think what is the impact? So there are two dimensions, more geopolitical world, and this could affect in particular the financial opportunities. So there is a Belt and Road Initiative, the G7 Partnership for Global Infrastructure and Investment. Does it create opportunities or challenges for the developing countries? This is an issue. And on the other front, climate policies and new industrial policy in the north. And this includes, in the case of the EU, I think the carbon border adjustment mechanism, which will have an impact, a large impact for developing countries. And as it is, at least, And I wonder how, you don't address this issue in the report, and I think it is something which is really important in terms of overall climate policy and in particular renewable investment. So let me stop there, and thanks a lot for the presentation and the reports.
Thank you. Please go ahead.
Thank you, Vincent. Before leaving Amelia responding to your questions, I will make a technical point. We have only 5 minutes left. There are a few questions from some participants. So, Amelia, if you can make it short, so that we can have a very small time for discussion. Thank you.
Thank you so much, Vincent, for the excellent summary and for the excellent questions and reflections. I don't have the time to go through all of them, but you raised an important issue, is the competition for FDI and the role of the new green industrial policy, especially in developed countries play. Of course, we don't go into the detail of the causal effect or the impact of those policies because we wanted to understand the drivers and the cost of capital, but they do play a role. And as you said, yes, for FDI competition. But this sometimes come accompanied by special investment measures that also are an issue of concern. But we wanted to see the other side of the coin. What is how prepared are developing countries, or how the policy making, national and the international agreements they participate can affect the attraction of FDI. The other issue is that FDI is not coming to the countries that it needs more. It doesn't mean that FDI doesn't play a role. On the contrary, and we have seen for many years that we cannot rely only on domestic resources mobilization, and it's important to improve the institutional and the absorptive capacity constraint of these countries. That's why we spend time analyzing the challenges and how those challenges can be addressed. That includes a reform of the international investment treaties regime, which the majority of the treaties are all generation agreements, which need to be revised because in many cases, this state dispute settlement issues can act against attracting investment into the renewable sector. So there is a lot on this. I do agree that these are important issues that we should look further, and these issues that we are going to discuss at the World Investment Forum. Then the issue about the future of globalization is a very important one. And a good news, if there can be a good news here, is that when we look at the industry, in FDI by industry, we saw that those industries that were struggling after the pandemic and because of the geopolitical situation, they were struggling with supply chain. They saw an increase in projects. So we have there the supply chain. Those dealing with supply chain challenges include electronics, semiconductors, automotive, machinery, all that. I mean, we saw a slowdown in digital investment. In the digital economy, but in general, the good news is that investment in those industries that were heavily affected because of supply chains during COVID saw an increase. Then there is a very pertinent question related to the role of central bank, and I think central bank in the chat, central banks are part of the policy equation of countries. I mean, they have many countries, especially advanced one, have moved to what they have done a green shift of policy making to address the energy transition, especially the European Central Bank and the Bank of England, which are the most sophisticated central bank around the world. Of course, they can be catalysts, but there is a trade-off in their involvement. Of course, they have to provide financial stability and they have to remain true to the roles, but also they can set up action in terms of facilitating the investment in the financial markets and the financial conditions. There are specific country risk also, as I mentioned before, and then governance risk also can impair central banks in their efforts to drive energy transition. But yes, they do have a role to play in designing regulatory and financial markets conditions. And these trade-offs have to be evaluated. It's an important thing a point that I want to make. Yes.
Thank you very much, Amelia. We'll have to close the session. We want to stick to the schedule. It was very enlightening, and the further discussion with Vincent showed us all the avenues for further discussions and studies. Unfortunately, we didn't have much time for the Q&A session, but it was already a very, very rich session. And once again, I thank you very much for your time, for the clarity of your explanations, and I am looking forward to welcome you for the next issue of the report. Thank you again.
Thank you. My pleasure, and look forward to continue the conversation offline and in person in Paris and in Geneva. And I invite you all to the World Investment Forum in October.
Okay, thank you very much, and have a wonderful summer.
You too. Thank you so much. Happy holidays.